Welcome back to Click Capital, everybody, and quite a bullish day here to finish out the week, especially so in the small side of the market. We've got the Russell, the winning index today, up 3.6%. The NASDAQ, not so much, didn't even finish up 1%. And most sectors finished today well into the green, except semiconductors. That actually came off today. And I still think we're making a bit of a topping pattern here in these overbought levels. But the winner today was regional banks, up over 6% on really strong volume and price action here today. And if you're new to this channel, welcome. My name's Jared, and every day after market close, I make these market analysis videos to bring you all the latest news, data, and charts of the day. So if you haven't already, hit that subscribe button, and these videos will show up on your YouTube homepage every day. And for my subscribers that have been watching these videos every day, I almost nailed the bottom. On the 11th of May, you can go back on my channel and check my video for that day. I let subscribers know of 10 cheap banks that were trading below liquidation value, and they've absolutely rocketed it up here today. And ever since I mentioned them back on the 11th of May, some of them are up almost 30%, a lot of them up over 15, 20%. And we just saw a lot of encouraging price action today in the cheap banks. It appears we may have found a bottom in these names, as they did get really cheap back here when I mentioned them, and I managed to pick up a couple of them myself. As like I said, there was a lot of good long-term value there for those that were willing to put up with the short-term volatility. And just looking at the heat map here today, we can see some of the old economy sectors have done really well, with industrials, energy, financials, and healthcare all having really good days. And what was different for a change was the mega cap tech acting pretty soft, most of them not even up 1%, and NVDA and a lot of the other semis actually finished down. The exception was Tesla, which had another good day and coming up to year-to-date highs. And here's a look at the year-to-date performance heat map, and you can just see the outperformance in mega cap tech so far this year has been absolutely crazy. Look at NVIDIA, up 169%. Even Apple and Microsoft both up almost 40%. Amazon up over 40%. Tesla 73, Meta 126. And we've still got much of the market in the red year to date. And here's a quick look at the forward PE of each of these stocks in this same heat map. And so this is just a multiple of the market cap versus what the company is expected to make in earnings next year. And so now we can see those stocks that have had huge outperformance this year are also really richly valued. You look at Amazon trading on forward PE 49, Nvidia 40, Microsoft 30, Apple 27. Let's switch over to price to sales. So that's the multiple of the company's market cap versus their last 12 months in sales. And we can see, for example, like energy stocks Exxon and Chevron just trading a little bit above their yearly sales. Walmart 0.64. But then look at the mega cap techs. We've got Google at 5. And Nvidia, the outlier on this chart here, trading at a huge 36 times sales. And same with a lot of the other tech stuff as well. And you might be thinking to yourself, sure, Jared, they should be hugely valued because their earnings have been growing significantly higher than the rest of the market over the last couple of years, right? Well, not so fast, because look at this chart here. This is the earnings per share growth rate over the last 5 years. And these mega cap tech stock names are much in line with the rest of the market. In fact, ExxonMobil and Chevron and a few other of the oil names have actually grown their earnings a lot faster than the mega cap tech. Amazon's actually gone backwards. Meta didn't even crack 10%. And would you believe it, Nvidia's average earnings per share growth rate over the last 5 years is below 10% as well. And so the market's got super excited with their forward guidance for their Q2. But the Q1 result they actually reported was actually down 15% year over year. Even JP Morgan and Bank of America have grown their earnings faster than Nvidia over the last 5 years. So you can see how carried away the market has got with mega cap tech in this year-to-date performance. And like I showed you yesterday in that chart, those top 7 mega cap tech companies, they now have bigger market cap than the financial, industrials, and energy sectors combined. But what really helped the market today was a blowout report on the non-farm payrolls. We were expecting the economy to create 190,000 new jobs, came in almost 80% higher at 339,000 new jobs. However, there is a lot more people available to work, and that's why we saw the unemployment rate actually tick up higher than we expected to 3.7%. And average hourly earnings ticked down a little bit to 4.3% year over year. So the market interpreted that as really bullish, and that big beat appears so as well. However, it was low expectations to begin with. And we can see that here on this chart, which shows the monthly job creation in the US. So we're just coming back to average, and we still had a bigger report back in January and July last year. So it's not a huge growth in the amount of jobs, but it does show that the jobs market is still holding up for now. However, I think a lot of people could be missing out the fact that the unemployment rate is starting to bottom out and curl upwards. And so this is a chart here of the monthly unemployment rate. And we can see that blow out during COVID. And if I just go and add a 20 bar moving average in this yellow line here, so that represents the average unemployment rate over the last 20 months. We can see that the current unemployment rate of 3.7% is sitting right at its moving average of 3.7%. And if I just go and add another indicator, recessions, which shows in this gray shading here when the US went into recession, we can see pretty much every time that the unemployment rate has gotten really low, then climbed above its 20-month moving average, the US economy has gone into recession. We saw that back in COVID. We saw that pattern back in 2008 when the unemployment rate went above its 20 bar moving average, we went into a recession. Again, back in 2001, we saw that pattern. Back in 1990, again in 1980, same in 1974, 1970, and so on and so forth. When you go back in history, all the way back to the 50s, we've seen this pattern when unemployment goes really low and above its moving average. Most of the time, we're going into a recession. So here we are today with the unemployment rate sitting right at its moving average. So in next month's report, if we get unemployment rate at 3.8 or higher, then it's very likely that we are going into recession. And that's exactly what the inverted yield curve has been predicting for a while now as well. And remember, never before in history has the stock market bottomed out before a recession. It's typically 6 to 9 months after the recession starts that the stock market bottoms out. So as it stands here, and according to strong historical patterns, the stock market could be vulnerable. And if we just draw a Fibonacci on the SP 500 from its October low back to its November high, we can see we are close to doing a 61.8% retracement. And between there and 65% is what we call the golden pocket. And that's where you see a lot of moves stall out and the retracement will finish. And that's exactly where we are now today on the NASDAQ as well. We're in that golden pocket retracement zone. And you can see here on the weekly chart, we're overextended above our upper buy-sell band where prices can stall out as well. And that huge year-to-date rally in the NASDAQ is thanks largely to AI-related stocks like NVDA and the rest of the semiconductors. However, will that AI ramp set the stock market up for a big fall eventually? When economic reality sets in, the Fed keeps jacking rates higher and eventually breaks the job market like they intend to do to really get on top of inflation, pushing the economy into recession, and with that, the inevitable compression in corporate earnings, their operating margins, and thus the yield differential between stock market earnings and bond yields blowing out, causing the stock market a huge fall to correct that. That is certainly one scenario I see playing out at some point later this year. But for now, the AI craze is well and alive, with investors pouring a record $8.5 billion into tech funds last week, and that's helping to keep the fear and greed index well in the greed zone here at 65. And the frenzy continues in the options market with a huge day today, 47.6 million contracts traded, and another whopping 59% calls. Once again, same old story, low put percentages in the mega cap tech. People just still loading into calls, betting that these mega cap tech stocks will go higher and higher and higher. Dark pool buyers still hanging in there and slightly bullish territory at 49% on the DIX. Corporate insiders are still net sellers on the whole. And another thing that's getting the market excited is that Fed fund futures are only pricing in a 1 in 4 chance that the Fed will hike in June. So that commentary we got out earlier in the week from the incoming Fed Vice Chair is they're looking to pause in June, wait for a bit more data to come in before making a decision on whether to hike again in July. And the market is still pricing in a 67% chance that they will hike in July. However, don't forget, we've got the CPI number coming out on June 13, on the first day of their 2-day meeting when they come out with their decision on June 14. So if CPI inflation data comes in hot, they still could very well hike at the June meeting. And that should upset the tech trade very much, as we're in very overbought levels here and tech typically hates higher rates. But because of the AI craze, tech has been still ripping in the face of the prospect of higher rates. Also helping the mood on Wall Street today was the debt ceiling deal getting through the Senate and now on the way to President Biden's desk. So there was a small risk that that wouldn't go through. However, that's gone through, and so the market can chill about that one. However, the showdown close to the wire may not come without a price. As Fitch said, it still may cut the AAA US credit rating, which still could cause shockwaves throughout the market. And the JP Morgan CEO still thinks there will be a recession at some point this year. And like I said, I think the Fed will have to break the jobs market because like he's saying we need to slow down in the economic cycle to deal with inflation. You kind of can't get inflation down without the jobs market breaking and unemployment going up above 4 or 5% before the Fed will actually then start cutting. But by then, corporate earnings are already dipping, and sentiment in the stock market will probably be very pessimistic by then too. Had a bounce back in crude oil futures over the last couple of days from support lows, as OPEC Plus is going to meet on Sunday to discuss its outlook for oil production. They're not happy with Russia as they continue to pump cheap crude oil into the global market, and because of Saudi Arabia's huge infrastructure projects and budget, they really need crude above $80 a barrel to pay for it all. And just looking at the chart on crude here, we can see we're at $71.80 a barrel today, still below the 50 bar VWAP. The last time OPEC met back here, they cut production by 1.1 million barrels a day, and we saw price shot up over 6%. And that's really where they want oils, around that 80 level. It's kind of the sweet spot for them. It's not too high that it affects demand and makes other alternative energies a lot cheaper relatively, and it's not too low where they don't optimize their profit a lot. So you've been hearing me talk for a while now about the kind of an unofficial floor on crude around mid-60s, because the Biden administration has to refill their strategic petroleum reserve as well. So every time we dip down here, they should be buying, and OPEC's just as likely to cut. However, the downward pressure on it is the biggest consumer out there of commodities. China's economy is a little soft, and global economic growth is a little bit soft as well. And that's best illustrated in the spread of the price of copper versus gold. Although we did get a nice little move up here today, so this could potentially be a little bit of a bottom. And apart from semiconductors, there was quite a lot of bullish breadth across equity markets today, even in the international stock indices. Got a nice bounce up here in the TSX. Same with the FTSE, DAX, Nikkei ripping out to new highs again in yesterday's session. And a little bounce in the Aussie and the China just kind of hanging in there. Volatility continues to dive again with the VIX super low at 14.6. And that's a trend we see often on Fridays, as it's really convenient for option dealers to have the VIX crush on Fridays when a lot of options expire. But contrasting that is the volatility of volatility, the VVIX index. Volatility pricing itself is still more elevated than volatility, and that actually finished a little bit higher today. Same with realized volatility. The actual movement in the stock market looks to have bottomed out in late April, but still pretty low here, sitting at around 13. Bond market volatility relative to stock market volatility is high as it's ever been. And another contrarian indicator, put-call ratio, still super low at 0.73. Big improvement in breadth today, with 63% of stocks now above their 20-day average. And that was a huge jump from yesterday, down at 34%. And this continues to make this market a lot more tricky and confusing. So now we've got half of all stocks above their 50-day average, and also long-term 200-day average. And this is a big one we've been watching here, because last time when the market peaked on February 2, we had 3/4 of stocks above their long-term average. And now the main indices, the SP500 and NASDAQ, have taken out those Feb 2 peaks. We've seen that huge divergence in the breadth of the market. However, that had a big pop-up today, and that's really what we have to see improve a lot more to really be able to get bullish on this market. However, it is tricky because, like I showed earlier, we still have the looming threat of a recession later this year. And where bond yields are now, stock market valuations are still pretty expensive relative to bonds. Got a little bit of improved breadth today in NYSE stocks making new highs at 72. Still nowhere near the Feb 2 peaks. Only 5 stocks made new lows today on NYSE, and 72 on the NASDAQ new highs, 14 on new lows. And there's the growth versus value stock spread chart. So you can see value stocks outperformed today, but still too early to call a top on this spread here, even though we really are overextended up at these levels. And there's a look at the Russell versus SP500, so small caps versus large caps. Had a really good day today, positive price action here on good volume coming off a low, now back above the 50 bar VWAP. So maybe smalls have bottomed out, and it looks like maybe the rest of the market is trying to catch up to mega cap tech here. Well, the top end of town had a bit of a breather today. And we can see a bit of that optimism in the bond market as well, with high yield outperforming treasuries today and coming back up to their April highs, but still underneath the levels when we got Silicon Valley Bank go under and we saw a bit of a collapse in the high yield treasury spread. So that strong jobs report supported bond yields here today, the 2-year up to 4.5 and the 10-year finding support back up to just under 370. And here's a look at the Fed Fund futures. We've got the June contract at 512, we've got September at 528 and December at 506, and these still look bullish in uptrends. So as it stands now, the Fed is not done with hiking their rates. We've still got at least 1 or 2 more hikes left in the bag. And with a strong jobs market and the NASDAQ ripping up to new highs and this AI hype and sticky inflation above 4%, there's no way Jay wants to see a bunch of frenzies out in risk markets again. He's going to want to cool it off with another rate hike, as his number one mandate is to get inflation down. So the market market could be in for a surprise in 2 weeks. If we get a strong CPI report come out, the Fed could very well hike rates again, and that could upset the tech trade. And with those higher rates today, we saw TLT pull back a little bit. And contrasting that was the high yield corporate bond, which actually finished above its 50. Dollar still hanging in there just below 104. And even with the strong rates and dollar, we still got commodities had a bump up today. Still wanting to reclaim this big support zone. Not giving up so easy. Although we've got gold struggling to get back above its 50. Got a lot of the overvalued software and cloud tech stocks getting to elevated levels, and we can see that in the ARK fund here. However, we do have a bearish divergence, as you can see on our hidden divergence indicator. Same with consumer discretionary stocks, getting into overbought levels, coming up to test their Feb 2 highs. But this looks like a weak move, and we can see that on our hidden divergence indicator. We haven't taken out the peaks from early April, and the market is still in range mode, as we can see down here. And something that could be a bit of a tell in the market is we've got this really green bullish day out there. But the sector that's really taken us to this place where we are today year to date, semiconductors, the AI chip trade, actually finished down today and looks to potentially be putting in this topping formation up here. Did get a strong bounce back in retail after being really oversold the last couple of days. Big move up in home builders back to year to date highs. Energy stocks having a bounce with crude. Another big bounce in defense stocks. You hear me talking about this support zone here. Looks to have held pretty well. And even old economy stocks, the industrials and transports having a good day on volume as well. And here's the breadth even in the defensive sectors. Look to have found support in healthcare. Staples had a really good day, and utilities hanging in there too, trying to find support. JP Morgan looks to be defending its earnings gap and resuming an uptrend back to year-to-date highs. Another good day for Tesla, now within 0.5 point of its year-to-date highs. NVDA just looks like the semiconductor sector and came off today. Apple and Microsoft found new year-to-date highs, but on really low-range days. Amazon looking extended up here, and same with Google, Meta, AMD and Netflix kind of all stalling out a little bit at these highs. Not much to report in the meme stock space today. We did see Big Bear and C3 AI come off a little bit. And there's a look at some of the retailers we got yesterday. Lululemon, Macy's and Nordstrom. And got a little bounce in Budweiser and Target. And the vulnerable regional banks, PacWest, Western Alliance, Zions and First Horizon all had a good day. Schwab as well, finding monthly highs. Okay, back to the main indices. We now got the SP500 just sitting under 4,300. And even though I've been moderately net short, coming in today, I did manage to finish the day up. And that's because I have been long some of the cheap stuff like the regional banks and other names that have gotten really beaten down. And I'm still short NVDA and some of their really other overinflated names. But this market is becoming more tricky, and we've seen that in that improving breadth. And because the market thinks the Fed is going to pause, the debt ceiling is done, the AI hype train, the jobs market's holding up, so all these reasons is giving the stock market something to hang their hat onto. However, we are coming up to those golden pockets in the SP500, already there in the NASDAQ. There is a lot of momentum in this index and the semis and tech, so it's hard to say exactly when it will top out. That's why I think it's important to keep a balanced portfolio of longs and shorts and not lean too heavily one way. And I do think having some longs in the small cap space, especially value stocks, could still prove to do well going forward, and they may be looking to catch up here. We can see that in the price action of the Russell today. Really big up day on volume, gapped up, held and finished near the highs, making multi-month highs here. And we can see that in the spread of small caps versus NASDAQ down here. Had this big up move today, up 2.8% on strong volume after these really beaten down lows. And so I think this could be a good way to play the market going forward, is long smalls, short bigs. And at some point that tech trade is going to run out of steam, especially if we get a surprise hike at the Fed meeting in 2 weeks. We're really looking at inflation CPI data for a read on that. But either way, inflation is still double the Fed's target, and with a tight jobs market and risk assets ripping, the Fed's got every reason to keep hiking. Until, in my opinion, they break the jobs market and have to kind of force a recession to get that inflation down back near 2%. So as it stands here, I've still got a portfolio moderately tilted, net short 40%, but of course you've got to be really selective as there's a lot of dispersion in this market. But some encouraging signs today that normality is coming back in, with the NASDAQ not even up 1% and the Russell up 3.6%. So a bit of a closing of the gap there. And that's all I've got for you this week. Thanks very much for sticking with me, and for all you guys that support the channel. And if you haven't already, hit that subscribe button, and I'll keep doing my best to keep you updated on this market and let you know how I'm positioned in it. Hope you have a great weekend, and see you again Monday afternoon.